All right, guys, before we crack into this episode, just a quick reminder, none of what we're talking about today is personalized financial advice. We're just talking in general terms about strategies or thoughts that you can have and you can potentially implement if it suits you to try and clear that mortgage as quick as possible. Now, get on with the episode.
We are back in your life, and today we're talking about mortgage rates. They're dropping like flies, and if you follow these steps, you could be hundreds of thousands of dollars better off. Michael, that's one hell of a headline.
It is one hell of a headline. Anytime we're giving tips on how to add a bit of wealth, to the bottom line, I love these episodes. They're good.
The great thing about this one as well is you don't really have to do anything differently. You just got to keep doing what you're doing opposed to taking that short-term relief.
No, I reckon it's more like banks hate this one simple trick. I reckon it's one of those ones.
Yeah. The banks will never tell you this one.
Yeah.
Okay, so pretty much what we're going to talk about today is interest rates are rolling off on mortgages, and you've got some really important decisions to make. And then we're going to talk about the longer term implications if you stick to this plan. Mike, give us a little recap. What's happened with mortgage rates over the last little while?
Oh, they're pretty low. They're around that kind of 1%, 2% mark. It's good times. And then inflation spikes like 8%. And everyone was like, holy crap, we got to do something here. So what did? We hiked those interest rates all the way up. Their peak interest rates for a 1 year rate was like over 7 or something. It's pretty gnarly. So what did that do? Well, in an ideal world, brings back that inflation. We can bring those interest rates down slowly. So where are we at the moment? Earlier this year, interest rates up in the 6s, right? Now they're down in the 4s. Starting to get to that mid-4s level, right? That means that is a lot of money that you were spending on interest, which is now getting put back in your pocket. So the real question is, James, what should you do with those dollary-doos?
You should keep giving them to the bank. Don't give them to yourself. Keep those mortgage repayments at the same level. Fundamentally, this is one of the biggest tips I can give in 2025 rolling into 2026. So what we're going to do is we're going to break this down around how it can impact your mortgage and then what you can do afterwards. So let's talk about some facts at the moment. The first one is the average owner-occupied mortgage is about $600,000. The OCR is pretty likely to drop to 2.5%. It might have already dropped by this point. New lending data shows the weighted average rate for a 1 year fixed rate is about 4.68, 3 year rate is 4.75, and a 5 year interest rate, Mike, is now only 4.99. I am hearing more and more people going, I want a 5 year rate. People want that consistency in their life.
Yeah, they do. I mean, that's not surprising given where we've been. You just got to remember those long term rates, they come with their own set of traps as well. So that's where we're at the moment, right? And let's say you were on a 6% interest rate, a 7% interest rate, an interest rate that was higher. As those interest rates come down, like I said, you can take that cash and you can either give it to yourself or you can give it to the bank. The argument for giving it to the bank, right? Let's say you have a $600,000 mortgage at 5.5%. On a 30-year term, you're paying $850 a week. Over the life of the loan, that's over $500,000 in interest that you're going to pay, right?
One more time on that, Michael. $600,000 mortgage. How much interest am I paying?
$500,000, James.
So I'm paying pretty much the same amount in interest as I did to get the bloody house.
Absolutely. And a 30-year loan term, a minimum repayment. You're still doing the right thing, right? You're still paying that loan off. I'm still following the path that everyone should. I bought the house, That is not the thing to do. You've got to pay this debt off as quick as you can. This is bad debt. You do not want this hanging around for 30 years. So let's say you kept your repayments higher, closer to what you were paying when you're in that kind of that 7, that upper 6% interest rate, and you shorten the loan term to 15 years. Repayments, yeah, they're going to be higher, $1,131 a week, but you would save, I hope you're ready for this, James, $344,000 in interest. One more time. You will save $344,000 in interest. That is, pardon my French, phenomenal.
So let's break this down, okay? So you've already done this. You've lived your life at 7% interest rates. All I'm saying is continue to be miserable. No, I'm joking. All I'm saying is carry on. keep doing the same thing. It is tempting to go, you can have an extra couple $100 a week if you do this thing. But if you can stay living your life at 7% interest rates, you can be 350 G's better off, Michael.
And like, James, but wait, there's more. Let's say you're like, actually, I still have a little bit of spare cash here, right? I could pull that to a 10-year term. Right, that'd make your repayments, they're getting high now. That's $1,500 a week. But you are looking at saving $444,000 in interest. That is the power of paying your mortgage off early and keeping those repayments where they've been.
So instead of, your biggest expense lasting for 30 years plus, you're getting rid of it in 10 years. The impact on what you can do with your life, the choices you have in the future are absolutely phenomenal. So holding the payments at a high level, you crush through those principal repayments. You save hundreds of thousands of dollars in interest. You shave decades off your mortgage, and you build resilience because interest rates won't stay at 4.5%, Mike. They're going to go up at some point.
Absolutely they will, right? And I think that's the big thing is if you're listening to this and you're going, you two are absolutely insane. I do not have $1,500 a week to pay off my mortgage. You're missing the point, right? What we're saying is everyone's in a different position, but the theory and the fundamentals are exactly the same for everyone. It's not about doing what your neighbor's doing. It's about doing the best you can do with crushing this mortgage.
The exciting part is that's phase one of the plan. And that's the short-term bit. That's the immediate action. Yes, you can pay off your mortgage faster. Yes, you can save so much money in interest. But that's not even the coolest bit. The coolest bit is what happens once you've got some equity, once you've paid down some debt. And we're going to talk to you about how you can achieve financial freedom after this break.
With interest rates shifting this fast, it's worth having someone in your corner that's got a plan for you. Lighthouse Mortgage Advisors can show you the way to save money on interest and the best way to pay your loan down as quick as you can. If this sounds like something you'd be interested in, get in touch with us today. Now, back to the episode.
So one thing that happens quite a bit, Mike, is people go, interest rates are now in the 4s. The share market's up 20% this year. Surely I should stop paying more to my mortgage and put more towards the share market.
We do often hear that quite a bit, right? And hey, it's really attractive to think that way. It's sexy to be investing in NVIDIA. It's not that sexy to be paying your mortgage down a little bit quicker. Where there is an issue here is that people are always comparing, or usually they're comparing a net cost to a gross return. And we've said this 1,000 times, right? If your share portfolio is giving you a 10% return, take off 1% for fees, a couple of percent for taxes, take off inflation as well. Very quickly, the return from that share portfolio is usually less than what you're paying on your mortgage. So you've got to be comparing apples for apples when you're making these decisions. The other problem I have with this, right? If you invested some money in NVIDIA, you're Warren Buffett. You know what I mean? Like you've picked a big stock. You cannot consistently outperform the market. The statistics are really clear on this, right? You will lose eventually, and all of a sudden, that 10% return, that's a loss. So now you got a loss in the share portfolio, and you got a loss at the cost in your interest. So again, just pay off the mortgage.
Yeah, 100%. We're going to do an episode soon on like the top, the Magnificent Seven that they always talk about in the S&P 500, the S&P 7 versus the S&P 493. You actually look at the long-term data around how long companies stay the top 7. Really interesting. So if you want us to do that episode, put it in the comments because I'm keen to do the research if you guys are keen to hear it.
Yeah, tell me I'm wrong. Tell me how much money you've made in your share portfolio.
Yeah, send us some screenshots.
Yeah.
We want the receipts.
Yeah, and I got to see the account number too. Yeah.
So a couple of things to point out. So your net return when investing into shares is usually like 3 to 4%. People might be talking about fees and all that kind of stuff. Yep, for sure. Rounded up to 4, you're still wrong. People go in, mortgage rates are now in the 4s. You've just got to remember, you can't think about the mortgage rate now. You've got to think long-term averages of where mortgage rates are. Long-term average is 5.5% since the last 30 years of data. So we should be thinking 5.5% versus 3 to 4. You're better off to pay off your mortgage. The next point people argue with me on, I might as well just argue with you in the comments right now. The next point is around Well, how come you apply inflation to shares, but you don't apply inflation to my mortgage rate? Well, let's think about this. If you are going to pay off your mortgage, you're never spending that money. You don't have to apply inflation because you're not going to use it later. Inflation doesn't apply. But the shares, at some point, you're going to take that money out and go and do something with. Therefore, inflation does apply. Anyway, comments come at me.
Right.
So don't invest until you've paid off your mortgage. However, if you follow our patent pending strategy of paying off, staying at 7% interest rates, knocking through your mortgage faster, let's use the example, Mike. You pay off your mortgage over 20 years, right?
Yep.
And you've got those extra repayments based off that. If you then take that money once you're debt free and you regularly invest into the share market over that decade, you're going to have north of $1 million of extra cash flow. So in scenario 1, we're debt free. Scenario 2, we're debt free with $1 million.
Yeah. And we're not saying investing into companies is a bad thing. We're not saying investing into funds is a bad thing. What we're saying is do things in the correct order that make sense mathematically, right? And for everyone who's like, oh, but I make all this money. Usually people don't. For everybody who makes big on their share portfolio, who picks the NVIDIA, when they were at $10 a share and now they're at 50,000 or whatever. You may do that. However, 99.9% of the people don't do that. Right? So they don't make those types of returns. So again, just do things in a smart way. You'll work out better.
Yeah. So pay down debt, then invest into shares. The great thing is the thing that can happen in the middle is buy an investment property. So once you've paid off you paid down some debt because you're paying it off faster and the value of the house goes up, Mike, there's this crazy thing called leverage and equity.
Yeah, you use a little bit of your money and a lot of the bank's money to grow the size of the investment, right? That's really one of the most powerful forces in the universe of investing, right, is leverage. Risky leverage, that's going to hurt you at some point, right? If you're leveraging on a Forex portfolio and you're betting against currencies, you can get stopped out pretty bloody quickly.
Be fun though.
I've tried it once. I tried it once in university. We thought we had it figured out.
Yeah,
I just remember the other way so quick. And we got stopped in 0.2 seconds on this bet. But anyway.
Good times, good memories.
Oh, great memories.
Rich in memories.
I went to one first year finance class that covered Forex stuff with short selling, and I was like, I have got this.
And you never turned up to the 9 a.m. lectures because it was too early in the morning.
So that's the thing, right? It's like the investment portfolio, the property portfolio, it's had a bit of a tough time over the last few years. And a lot of people are now questioning, is it even worth going into property more? We might have a capital gains tax in the future. What does that do for property investment? Look, even within the asset class that is property, there are different kind of sectors to it, right? There's commercial, there's multi-unit stuff, there's strategies about buying, renovating, revaluing. There's just the townhouse for your first one or something like that. Not all properties are created equal. And if you're smart about where you're investing in the market, there's markets within markets, right? If you're smart about where you're investing your money, I still think there's a lot of opportunity in the property game.
We've also got a banger of an episode coming up around is investment property in New Zealand dead? So make sure to subscribe to the channel so you don't miss that one. Fundamentally though, once you've paid down some debt, the value of your house goes up. The math is if you buy a $700,000 property, when interest rates were at 7 and a bit percent, your top ups were $30,000 a year.
Oh, that hurts.
With the interest rates where they are now, it's more like $12,000 a year. So this becomes significantly more affordable. And then obviously as you pay off more debt on your own home, if interest rates do go up, you've got more levers to pull because, in general, you've got a lot less debt to manage.
Yeah, 100%.
So investment property, while it might not be for everybody, it becomes an option and you need to understand how it works. And actually, there's no point in having any freaking discussion until you pay down some debt, the value of your house goes up.
Yeah. So, James, it almost sounds like it's this weird thing. It's almost like a plan, like a financial plan of some description, but maybe putting some plans in place.
Yeah.
Spending less than you earn, maybe saving a bit, maybe paying off that mortgage, maybe doing an investment. That's so strange.
I know. Don't be too conservative. Don't be too aggressive. Don't try and knock it out of the park. Just be consistent over time. We'll pop a link in if you do want to have a free 30-minute chat with a financial advisor because you might want to talk about some stuff with your own situation. But fundamentally, this all comes back to interest rates were at high. You're at 7%. If you can just stay at 7%, Well, we're talking about a decade. A decade, I know it feels like a long time. I mean, with the way Mike lives, it's been a long decade for him. But the biggest thing is there's so much you can do over a decade. But just start with keeping those repayments as high as you can. Yes, you don't want to be miserable. Yes, you're never going to be younger than you are right now. Yes, a trip to Fiji is getting more and more expensive, but do the best you can with what you got, like my boy over here, and it's amazing where you can go. Well, we're going to wrap it up there. I'm sure people are going to have lots of things to say in the comment section. Pop them in there. Maybe we'll reply to some of them. You should stay away from the comments. They don't say nice things about you.
Yeah.
If you want to see the episode where we talk about is investment property dead in New Zealand, make sure to subscribe to the channel, give us a review, give us a like, and we'll catch you next time.
Cheers.